Hello guys, today we're going to talk about chart patterns. Chart pattern is another simple yet powerful tool that you can add to your trading arsenal. What's so important about chart patterns is that they show you exact risk to reward ratios. They show you exactly some specific places to place your stop loss depending on your risk, and they show you exactly where you're supposed to place your take profit. So they're pretty reliable to trade. Today we're going to explain the most famous and important chart patterns. I'm going to explain how to find the patterns in the charts, and I'm going to show you how to trade them. It's very important for chart patterns, as with Japanese candlesticks, to trade them in context. Don't try to find random patterns in the chart and try to trade them. Always look at the context. Look at if they need to be after a trend if they're reversals, and they need to be in a trend if they're continuation patterns. There are two categories of chart patterns: reversal patterns and continuation patterns. Reversal patterns are found after a strong movement, most usually a trend, and they signify and show that the possible reversal might happen. You can also find reversal patterns in the top of big channels with a sharp movement before them, or you can even find them on the trend lines if there is some sharp retracement during a big trend. Continuation patterns are also found during a trend, but they don't show the reversal of a trend. They signify that the trend is continuing its current course. So sometimes in a trend you trade multiple times in a trend, and you can use the patterns to trade very reliable signals. First we're going to talk about reversal patterns. The simplest and most typical pattern to search for is a double top or double bottom pattern. If the pattern is found in the top of an uptrend, it's called a double top pattern. If the pattern is found in the bottom of a downtrend, it's called a double bottom pattern. I'm going to show you to CTrader what I mean exactly by double top and double bottom. So I'm going to walk you through, and you can understand what a double top pattern is and how generally patterns are made. Here we have a trend. As we said before, in order to find the reversal pattern, it must be in the end of a trend. The trend is progressing normally. It creates lower lows and higher highs. This happens until the first part of the double bottom pattern. Here we have also a higher high, but what's important here is that even though we have a higher high, the bottom of the retracement of a trend is not higher than the previous low. So we have a higher high, but the low is not higher than the previous low. This is an indication that the pattern might be forming. The next swing of the pattern, we see that the high of the double top pattern cannot go above the previous high. So a resistance is formed here that is not broken by this swing. Then it starts descending, and the pattern is confirmed when the support, which is on connecting the lows that we saw before, is broken at this spot. This is the typical double top pattern. I'm going to show you how to trade the pattern now. I'm going to show you with limit orders. So let's make a sell limit. Of course, you're trading in the other direction, not the direction of the trend. The support is broken, so you're going to enter short. You can enter short immediately at the break, which is, in this case, it would be successful, but generally is not recommended. You can also enter short at the first candlestick completely below, that's plotted completely below the resistance. In this case, this is not good because the candlestick is very long, so you would find another candlestick. You can also trade it on the retest. So after the resistance is broken, it's going to be retested again, and then we have two spots. Here it's retested once, and here it's retested twice when we can enter. Let's say that we're going to trade immediately on the first candlestick that breaks that pattern. You can put your take profit very conservatively with just above the candlestick. This is an extremely conservative stop loss. It's not bad, but it may hit. You will have to re-enter again with another conservative stop loss. You can put it less conservatively, which is mostly recommended, which is the previous small swing high. You can go above here, so you know that we have a swing here. It's very hard. If we go above that swing, the pattern is not successful. Or you can go one-to-one stop loss and put it where at the high point of the pattern, which also is not very much recommended, but you can do it if you want. The target for this pattern is you measure the distance between the resistance and the support, which is 52 pips, and you put something a bit more conservative. If it's 52, you're going to put like 45 or up to 50 just to make sure. So you can put 45 here, and the whole point is that the same the height as the pattern is going to go on the opposite direction, at least that. If it's going to be another reversal, another trend, it's going to go even lower. So that's how you trade the double top pattern. Here we have a double bottom pattern. I'm not going to go too much into details about that because it's the same as the other pattern. The only difference is that it's at the bottom of a downtrend. Again, we have the same formations, but what I want to show you here, I want to show you a tip since I've drawn this indicator, relative strength index. A good way to confirm your double tops and double bottoms is by using a technique called divergence. With divergence, we plot an oscillator like relative strength index, and what we're seeing is that even though the lows in a downtrend or the highs in an uptrend, you see that the low is even lower than the previous low, just a bit lower, but still, or it's the same low if it's a perfect double bottom. Even though it's at the same level, if you go to the oscillator, you're going to see that these 2 points are not do not have the same slope. As let's make the slope, so I'm going to show you. Here we have a downward slope, and here we have an upward slope. So it shows you that actually the reversal might be happening because there is a difference in slopes. It shows you that the trend is weakening. So that's it about double top and double bottom. Now we're going to move to the next pattern, also famous pattern. It's called the head and shoulders pattern. The reason why it's called the head and shoulders pattern is because it looks like a head and shoulders. Here we have 2 shoulders, 1, 2, and we have a big head between them. So let me go through this pattern. It's again after a trend. You can find the trend is continuing, higher highs, higher lows. Again, it forms a shoulder, then it forms a head, higher high, higher low. At this point, we have no clue that there might be a head and shoulders pattern because it's like if we see only this level here and before, it looks like a normal trend. What makes this so special is that we have another low, which is equal most of the time as the previous low. In this case, it's not equal, but we have another swing that completely fails to go below the head, and most commonly it completely fails to go below the previous shoulder, but sometimes it goes below the previous shoulder. This is a head and shoulders pattern. We have a resistance that's called a neckline, that is the line that connects the lows in this particular case. You can either draw it here. This is actually not a wrong trend neckline. It connects all the low points that we talked before. You can draw it here. This is also a neckline, so it's up to you to draw it perfectly. Nothing is perfect in the market. What matters is that when the neckline is broken, that's when the trend is confirming. So depending on where you draw it, it's confirmed here or a bit below. Still, it's the same spot. Actually, it's a very small difference here. I'm going to show you how we enter. Again, you can enter it immediately on the break, like this. You can enter on the first candlestick that is plotted below the trend line here. Not recommended with this kind of patterns because you go very low. Or you can enter it at the retest, which is here when it goes down and it retests the support. you can enter somewhere around here. Your stop loss can be conservative, very conservative right above the candlestick, can be less conservative on the previous swing above the previous the shoulder, or it can be not conservative at all, 1-to-1 actually above the head of the pattern. The target is the distance between the high point of the trend. You measure the distance between high point of the trend and the neckline. This case is 28 pips. You put 25 just to make sure, and you can put a 25 pip take profit. And that's the pattern. That's a head and shoulders pattern. Usually both the head and shoulders and double top patterns are at a side of a trend that is not broken yet, like here. Next we're going to show the head and shoulders reversed, which is in the bottom of a downtrend. I'm not going to go through the head and shoulders, the reverse head and shoulders, because it's the same as the other direction. It's again traded on the neckline, but on the positive break instead of a negative, so upwards. So we're going to go buy here, we're going to go long. Our target is going to be again same height between neckline and top of the head. So we can put the take profit at 600 pips. Stop loss depends on your risk appetite. Again, we said before previous swing, below the previous swing, below the shoulder, or below the candlestick. Next pattern that we're going to talk about is called the triple top. It's a pretty simple pattern as well. This pattern is the same as a double top, only it has 3 tops. But what's important is that these 3 tops need to be making a very clear resistance. Like we see in this case, they are at the same level. And also there is like a wick of the candlestick going only above the resistance, so this is a pretty clear resistance. The way to trade it is when the support is broken, they also form a channel, the resistance and the support. When the support is broken, you go short. So let's create a limit order here. And let's remove this one. And again, you can trade it on one of the candlesticks or immediately on the break of the support. Same target, same as the height of the channel. This case is 50 pips, so your target is going to be 50 pips or 45 if you want to be sure. Your stop loss can be conservative up on the top of the channel of the candlestick, or less conservative like in the previous swing, which is like this is the best stop loss in this case. Or you can go 1-to-1 in above the resistance. This is also a reversal pattern. It's found after some after trends. Next pattern that we're going to talk about is a wedge. The wedge is found during is also a reversal pattern mostly. Sometimes it's a continuation pattern, but mostly it's a reversal. It's found during a trend. What a wedge is we connect the highs and the lows during a trend, and we see that the lines that connect the highs and the lows, instead of being parallel, they go towards each other. In this case, we have a formation that looks like a wedge. That's why it's called a wedge. The wedge is in the direction of a trend. However, it signifies a reversal. So we're supposed to trade it the other way. The way we trade the wedge is after this resistance line is broken, we enter here. Again, same thing. We can enter the first candlestick that broke it, or we can enter immediately at the break, or we can even trade the retest of the line. Our stop loss conservative, like here or here, less conservative on the bottom. And the amount, the take profit that we want to get is the biggest distance between these two lines. So if we measure this distance, it's 175 pips. So we're going to place our take profit at 170, and that's the trade. That's how we trade the wedge If it was an uptrend, the wedge would be going upwards, not downwards. So that's it about reversal patterns. I've shown you the most commonly used and simple reversal patterns. Now we're going to talk about continuation patterns. Continuation patterns are found during a trend, and they show you that the trend is continuing. We often trade multiple times during a trend, so this information is very useful for you. The most commonly used continuation pattern is called a triangle. We have three types of triangles. One is an isometric triangle, the other one is an ascending triangle, and the other one is a descending triangle. So let's go to CTrader and we're going to show you how to find triangles and how to trade them. Let's go to the next chart. Here we have an ascending triangle. We have an uptrend, as we see here, it's going up. The ascending triangle is made by a resistance line being formed on the top of small swings in the trend. So the resistance line is, however, is straight. It's a straight line. The other line of the triangle is connecting the lows in an uptrend, and we see that these two lines will create an ascending triangle. The pattern is traded when the price breaks the resistance that is formed by connecting all the high points here in this straight line, and I'm going to show you how you can trade it. It's so apparent that this is a bullish pattern because you see that the tendency of the price is to go up. Let's create another limit order. So we're going to trade it immediately after the break. If we try to break it to trade it after the complete candlestick, it's going to be very high, so we're going to actually miss the signal. So in this case, it's the only case that we can trade it. There was no retest, so we either trade it here or we miss it. The stop loss can be conservative, just below the candlestick, like very conservative, or it can be less conservative, below the previous low swing, or it can be 1-to-1, which is going to be this low. Below the previous swing is the best stop loss. Your target should be the biggest distance between these two lines. So if we measure this distance, it's 280 pips. You can put the 260 just to make sure. So this is a trade that you would make with an ascending triangle. Next type of triangle is an isometric triangle. You see here why it's called an isometric triangle, because it's exactly an isometric triangle. Let me explain to you the difference between a triangle and a wedge, just to make sure that you understand correctly. A wedge is when we have two lines that go towards each other, but both these two lines have a slope. You see, in this case, in an uptrend, the wedge would look like this. Both of the lines have a slope. However, a triangle is either an isometric one, like the one we have here. You see that it's perfectly made, or an ascending triangle and a descending triangle always have a straight line. This is an ascending triangle, and this is a descending triangle. So that's the difference between a wedge and a triangle, as I explained. Let's move on. This is an isometric triangle. It's traded exactly the same as the previous triangle, only the resistance line in this case has a slope. When the resistance line is broken, we enter long, and our stop loss, again, conservative, less conservative. Below the previous swing is always a good spot to enter. And the take profit is the biggest distance between these two lines. So in this case it's 82 pips, and we're going to put 82 pips, or less at 75 pips, just to make sure. You see that with these continuation patterns, because we already have a trend moving, you see that the break is very powerful. It's not like the reversal patterns that there is almost, usually there is almost always a retest of the resistance. The reason why there is always a retest of the resistance, like we've shown here, for example, is because this is a reversal pattern. It reverses the trend. There are still people that believe that the trend is going to continue, and they push the price up. However, because this pattern is during a trend, everybody is on this direction anyway, so when it breaks with power. So it's recommended to trade the continuation patterns immediately and at the break. but with reversal patterns you can wait to trade them in the retest. Next pattern that we're going to show is a descending triangle. I'm just going to show it to you. I'm not going to explain anything because it's exactly the same as an ascending triangle, only the resistance line is in the bottom. Again, you trade it on the break. Your target is the same as the distance between the lines, conservative or not conservative stop loss. The last pattern of this presentation, and also the last continuation pattern I'm going to show you, is called the flag. The flag is a pattern that's done again during a trend, and it looks like a straight channel. It's a channel of support and resistance. That's why it looks like a flag. Look at this, because there is always a trend before the flag. So there is sharp movement, and it looks like a flag because of the way it's created. The point of the flag and what makes it different from the wedge is that the lines are parallel. So even if it was like this, the lines are completely parallel. When the flag is broken, usually it's broken in the direction of a trend. We trade it after when the resistance is broken. Again, because it's a trend, maybe we don't want to wait for the retest. So we're going to enter here. Our stop loss again can be below the candlestick. In this case, this is enough because you see it's a big distance, so we don't need anything more. Or it can be less conservative at below the previous high of the swing, or 1-to-1 on the beginning of the pattern. Our target is the distance between the lines, pretty straightforward. This was 65, so I'm going to put 60 just to make sure. And that's how you trade, you would trade a flag. In this video we talked about chart patterns. As I've shown you, chart patterns is a very simple and yet powerful tool because they show you exactly what you're supposed to do. The only decision making in your part is when to enter, and still you have only a couple of ways to enter, either on the retest or immediate break. It's recommended to enter immediately on the continuation pattern and on the retest on reversal patterns. They show you also exactly what your stop loss is going to be depending on your risk and what your take profit is going to be. Just remember not to randomly try to find patterns in the chart. Always be looking them in context. You need a trend or a sharp movement before a reversal pattern, and you need to be in a trend for a continuation pattern. In the next video, we're going to talk about trend indicators. If you enjoyed this video, please subscribe to our YouTube channel and don't forget to share it with your friends. Thanks for watching.